Good evening, and welcome back to SleepWise. As a reminder, you can listen to this and every SleepWise story completely ad-free on Spotify and Apple Podcasts. Tonight, we drift back to a time of easy confidence when headlines spoke of prosperity and the future felt steady. In the early years of the 21st century, economies around the world enjoyed what economists called a great moderation, a period of stable growth, low inflation, and broadly low interest rates. Credit was cheap and plentiful, and the hum of construction cranes set the rhythm of countless days. In the United States and many other countries, house prices climbed year after year, and the glow of rising home ownership brought a sense of security and pride. People borrowed to build their lives, trusting that the bricks and mortar beneath them would hold. Lenders, buoyed by competition and by years of calm, extended loans to more and more people. For a moment, it seemed that the cycle of saving and borrowing, of work and reward, had found an equilibrium. In this gentle landscape, financial markets grew in complexity and size. Banks packaged mortgages into bundles and sold them as investments, spreading the promise of steady returns across continents. Globally, investors sought opportunities and the quiet assurance that home prices would only rise justified ever larger risks. Governments observed the expansion with satisfaction, noting employment growth and the steady hum of the housing sector. Average home prices in the United States more than doubled between the late 1990s and 2006, and home ownership rates reached levels not seen before. Mortgage debt rose from roughly 60% of national output to nearly a full year's worth of production. But with interest rates at historic lows, repayments felt manageable. In markets near and far, similar stories unfolded. Borrowed money, poured into bricks and glass, promised to create wealth that would endure. The lull of the markets and the comfort of the everyday masked the fragility inherent in all great booms. Yet, for now, the world breathed in the calm, the soft light spilling across suburban lawns and city skylines, unaware of the currents that would soon stir beneath the surface. Those years carried a particular kind of optimism. Television hosts repeated phrases like, "House prices never go down," and friends compared the equity they had accumulated on paper. Banks created ever more loans to feed the demand, and families refinanced to pay for college, kitchens, and holidays. The orchestra of prosperity played on, with only the faintest hint that some instruments were slightly out of tune. Few paused to wonder what would happen if the tempo changed, if interest rates rose or house prices fell. The assumption that tomorrow would look like today had settled into the collective mind like a comforting lullaby. Tonight, as we revisit those years from a gentle distance, we can feel the texture of that optimism, light, warm and full of hope, and sensed the delicate balance on which it rested. Far beneath the surface of that tranquility, like small cracks forming beneath ice, the seeds of strain were already being sown. Easy credit was not reserved for the most dependable borrowers. As house prices climbed, lenders searched for new customers, relaxing standards and reaching out to people who would once have been turned away. Mortgages were extended to households with fragile incomes, and some loans required little proof of ability to repay. To many, these offers were the chance to step onto the ladder of ownership. To others, they were invitations to speculate, to buy houses not to live in, but to sell again quickly for a profit. These high-risk or subprime mortgages carried low introductory rates that would reset higher after a few years. Borrowers were told that by then their homes would be worth more, that they could simply refinance or sell. Across kitchen tables and in the offices of mortgage brokers, pens scratched across paper like tiny waves on a still pond, binding people to obligations that quietly grew heavier as they stretched into the future. Behind the scenes, the process of turning these mortgages into tradable assets intensified. Rather than hold a loan and collect payments over decades, lenders bundled thousands of loans together and sold the packages to investors. These bundles, called mortgage-backed securities, mixed solid loans with risky ones and were divided into slices that offered different levels of return and risk. Ratings agencies, using models that assumed broad rises in house prices, labeled even complex and opaque bundles as safe. Investors, from pension funds and insurance companies to banks in Europe and Asia, eagerly bought these securities. The very act of selling the loans to distant investors reduced the incentive for lenders to assess whether borrowers could repay. A chain of intermediaries, each taking a fee, turned the simple bond between borrower and bank into a web of contracts that spanned the globe. As the chains multiplied, so did the leverage behind them. Many investors borrowed heavily to buy these securities, magnifying their potential profits and their potential losses. Banks and financial institutions placed bets on the continued rise of house prices using complex derivatives tied to mortgage performance. The risk seemed dispersed, almost abstract, because it was no longer held in a single institution, but spread across portfolios, continents, and balance sheets. In spreading the risk so widely, the system had also connected many institutions to the same underlying asset, a house that might, in time, decline in value. While families enjoyed the warmth of new living rooms and investors counted yields, the foundation of trust on which these arrangements depended grew more complex and fragile. The quiet hum of prosperity masked connections that would soon transmit a shock around the world. Far beneath the buoyant housing market lay deeper currents, like a slow tide rolling in from distant shores. Low interest rates had not simply fallen from the sky. They were the product of policy choices and global imbalances. After the recession of 2001, central banks kept policy rates at historically low levels to stimulate growth and ward off deflation. At the same time, savers in emerging economies, particularly in parts of Asia and the Middle East, accumulated vast sums and sought safe places to invest. These global savings gluts flowed into advanced economies, pressing long-term interest rates even lower. Cheap borrowing costs encouraged households to take on mortgages and encouraged businesses to invest. They also shaped the behavior of institutions from community lenders to the most sophisticated investment banks. When money is inexpensive, the discipline of deciding when and where to lend or invest can weaken, and the line between prudence and speculation can blur. In this environment, ideas about risk shifted subtly. Models used by banks and rating agencies looked to decades of rising house prices and concluded that broad declines were extremely unlikely. Past patterns fed assumptions about the future, and the stability of the Great Moderation was extended forward almost indefinitely. Regulations had not kept pace with innovation. Financial institutions that operated outside traditional banking, often called the shadow banking system, performed bank-like functions, such as borrowing short-term and lending long-term, but they were subject to lighter oversight. Products such as collateralized debt obligations and credit default swaps expanded rapidly, transforming pools of mortgages into structured layers of debt and insurance. Each new structure promised to spread risk more effectively, yet each added another link in a chain that few people fully understood. This period also saw a shift in how people thought about homes. A house had long been a place to live and a store of security. During the boom, it became for many an investment vehicle, a lever to extract cash through refinancings or to speculate on future price appreciation. Conversations in cafes and on radio shows revolved around property values and the ease of borrowing. That sense of paper wealth encouraged consumption and reinforced economic growth, creating a feedback loop that seemed virtuous. Even those who sensed the risks often felt powerless to step aside, because in a rising market, choosing caution meant watching others prosper. Thus, the logic of the era, shaped by low rates, abundant capital, and a belief in perpetual appreciation, led individuals and institutions alike onto increasingly precarious ground without a ripple disturbing the surface. The music of markets carried a gentle melody, but beneath it a dissonant chord was forming. As the years passed, leverage quietly became the lifeblood of the boom, like a river of borrowed money coursing through markets. Borrowing to invest is not inherently reckless. When used thoughtfully, it can accelerate growth in a shop or factory. In the mid-2000s, however, borrowing to buy financial assets became a hallmark of the era. Banks and investment funds use short-term loans, sometimes borrowed overnight, to purchase securities tied to mortgages and other long-term obligations. This maturity mismatch where funds could be called back quickly while the underlying investments could not be sold easily, created a dependency on continual renewal. So long as lenders were willing to extend credit and markets were calm, the system functioned smoothly. The profits from holding leveraged positions were amplified, encouraging institutions to take on more exposure. To outsiders, balance sheets appeared strong, yet much of the strength rested on the assumption that markets would remain liquid and lenders would always be willing to roll over financing. Within banks, risk managers and traders worked with models to measure exposure. Leverage ratios climbed as capital was used to support larger and larger positions. Executives assured investors and regulators that their risk was diversified, that they could withstand shocks because their assets were spread across many sectors and geographies. But diversification was often an illusion. Many of the securities held by different institutions were linked to the same asset, housing, and were priced using similar assumptions. The growing interconnections meant that trouble in one corner could quickly reverberate across the financial system. In the shadow banking system, entities like money market funds and securities lenders operated with few buffers. Their investors could withdraw funds on short notice, and their ability to provide liquidity depended on the confidence of others doing the same. The reliance on leverage also influenced behavior at every level. Traders earned bonuses based on short-term profits, incentivizing positions that looked profitable in stable markets, but were vulnerable to shifts. Regulators, who might have dampened the buildup, lacked information about the scale of leverage outside traditional banks and were often constrained by legal frameworks that had not anticipated such complexity. Public discourse rarely dwelled on how brittle such a system might be. Instead, the prevailing narrative celebrated efficiency and innovation, praising financial engineering that appeared to reduce risk while enhancing returns. Underneath the accolades, the very mechanisms that magnified success were setting the stage for sudden and sweeping reversals. It was as if the entire financial edifice had been elevated on stilts. Impressive to behold, but increasingly sensitive to the slightest tremor. As lending standards loosened and leverage climbed, another force silently shaped the course of events. The framework meant to guard against excess, like a watchman dozing at his post. Regulations designed in earlier decades did not fully account for the innovations of the new century. Mortgage brokers operated with limited supervision, and lenders often profited by originating loans and selling them on, rather than by ensuring they would be repaid. In the United States, entire segments of the mortgage industry fell outside federal oversight, residing in jurisdictions with lax rules. Borrowers were sometimes steered into loans they could not afford, or into complex adjustable-rate mortgages whose future payments would jump dramatically. For many borrowers, the excitement of purchasing a home obscured the fine print. For many lenders, The incentive to close deals outweighed the incentive to assess long-term affordability. On a broader scale, regulators underestimated the extent to which risks were building in the financial system. The assumption that markets would self-correct and that participants had strong incentives to manage their own risks influenced policy decisions. Rating agencies, whose opinions shaped how investors viewed the safety of securities, relied on historical data and models that assumed housing markets would behave as they had in the recent past. As a result, securities backed by risky loans often received high ratings, encouraging investors to hold them. In the shadow banking world, entities that looked like banks in all but name had grown rapidly, but faced far fewer requirements to hold capital or maintain liquidity. The absence of coordinated oversight allowed vulnerabilities to accumulate unnoticed until they became too large to ignore. Policy also played a role through what it did not do. The low interest rates that followed the 2001 downturn were maintained longer than some observers expected, partly in response to the mild recovery and worries about job growth. Some critics later argued that such policies helped fuel the housing boom by making mortgages more affordable and encouraging risk-taking. Others pointed to a global environment awash in savings as a more important factor. Regardless of the exact mix of causes, the combination of easy credit, insufficient oversight, and optimistic assumptions created a system in which resilience was gradually eroded. When institutions are left largely to police themselves, and when complex products are rated as though they were simple, it becomes easy to forget how quickly conditions can change. The stage was set, and though the streets remained quiet and the light continued to fall softly on newly painted walls, the balance between caution and exuberance was tipping. The guardians of stability, distracted by the calm, did not fully grasp the scale of the tide that was rising. The first signs that the gentle ascent could not continue forever appeared quietly, like distant ripples on a calm lake. House prices, which had been climbing for years, reached a plateau in many areas around the middle of 2006. In some regions, they began to decline. At first, the change was so gradual that it passed without comment. A slower pace of sales, a slight reduction in bidding wars. But for borrowers whose mortgages were due to reset from low introductory rates to higher ones, even a small drop in prices mattered. Many households had little equity. Some owed more than the house was worth. As payments increased, budgets stretched to the limit, and foreclosure notices began to appear on doors and in local newspapers. Subprime lenders, which had grown rapidly during the boom, began to falter. Delinquencies on their loans rose and some firms closed. Their troubles were initially dismissed as contained within a narrow segment of the market. Policy makers and commentators suggested that the wider economy was strong enough to absorb the losses. The narrative of contained risk was comforting, but it obscured how interconnected the system had become. The securities backed by those risky loans were held by a wide array of investors, many of whom did not yet grasp how far the rot had spread. As 2007 dawned, news of rising defaults and the failure of a few investment funds reached the front pages. Yet, for many, life went on as before. Housing starts slowed, and construction workers laid down their tools, but shopping centers still bustled and cafes were full. The unease was like a faint vibration underfoot. Those paying close attention could sense that the tremors might become more pronounced, but most people continued to move to the music that had accompanied the boom. In hindsight, it was a pivotal moment, the cresting of a wave that had been building for years. The drop in house prices and rising missed repayments were early indicators that the foundation of the boom was shifting. Like a tide turning quietly under a bright sky, the direction of the current changed before many had realized they were already being carried along. By late summer of 2007, stresses moved from the periphery to the heart of the financial system. Investors grew wary of mortgage-linked assets, and the market for a short-term funding instrument known as asset-backed commercial paper seized up. Companies that relied on this market suddenly found it difficult to borrow. Central banks responded with emergency liquidity, an early recognition that something more than a contained problem was unfolding. Still, many policymakers voiced optimism that the disruptions would be temporary. The full implications of the housing slowdown and rising defaults were not yet understood. The world remained suspended between the memory of boom and the shadow of what was to come, pausing briefly as if at the top of a roller coaster before gravity took hold. As autumn turned to winter, the tremors of 2007 deepened like the quiet rumble before a storm. Early 2008 saw a series of events that, in quieter times, would have been extraordinary. Now they were markers along a path few had imagined traveling. In March, an investment bank with a storied history, Bear Stearns, found itself unable to fund its operations. The firm had been a major player in mortgage-linked securities and relied heavily on short-term borrowing. As confidence evaporated, its lenders refused to renew their loans. Over a tense weekend, regulators and bankers worked through the night. A failure could have sent shock waves across the system, threatening countless counterparties. With the assistance of the central bank, another institution agreed to take over Bear Stearns at a fire sale price. It was an unprecedented intervention, a recognition that the crisis had moved from isolated lenders to the heart of Wall Street. For some, it was the first clear sign that the financial system's safety net was being stretched. In the months that followed, other signs emerged that the web woven during the boom was unraveling. Banks reported large write-downs on their holdings of mortgage-backed securities. Homeowners continued to fall behind on payments, and house prices kept declining. In neighborhoods where speculative building had been rampant, half-finished homes stood in silent rows, their frames bleached by the sun. To stabilize markets, central banks lowered interest rates and created lending facilities to provide liquidity to institutions locked out of normal funding channels. These measures eased the immediate strain, but could not reverse the underlying trend. Confidence, once shaken, is slow to return. Each new rescue affirmed that the problems were systemic rather than contained. Yet many still hoped that the turbulence could be managed without wider collapse. As summer approached, the trouble spread beyond Wall Street. Two giant government-sponsored enterprises that guaranteed and purchased mortgages, long considered pillars of stability, announced that they needed support. Other banks and insurance firms reported unexpected losses. Overseas, institutions that had purchased American mortgage securities faced their own difficulties. The crisis, once described as "made in America," was becoming international. Investors around the world began to ask the same question. If an investment once rated as safe could lose so much value, what other assumptions might prove false? Through it all, everyday life continued. Children attended school, buses ran, flowers bloomed, but the hum of unease grew louder like a distant drum. The protective layers that had kept risks hidden were thinning, revealing the interconnectedness of a system that spanned continents and linked the aspirations of millions. The contagion did not respect borders. By 2007, banks and investors in Europe and Asia had enthusiastically joined the American housing boom, purchasing mortgage-backed securities and funding them with short-term borrowing. When U.S. house prices began to fall and losses mounted, these institutions found themselves exposed to the same forces that were shaking Wall Street. A British bank, Northern Rock, experienced a run as anxious savers lined up outside branches to withdraw their money. The first such scene in the United Kingdom in more than a century. In Iceland, a handful of banks that had grown rapidly by borrowing abroad to finance domestic lending teetered as foreign funding dried up. In Ireland and Spain, property developers and banks that had bet on endless housing demand faced growing inventories of unsold homes. The crisis's reach underscored the extent to which financial markets had become interconnected. A mortgage issued in a suburb of Cleveland or Phoenix could be sliced, repackaged, and sold to a pension fund in Dublin or a bank in Frankfurt. When trouble emerged, the ripples returned along those same channels. The global nature of the problem created challenges for policymakers. Each country had its own regulatory framework and its own economic conditions. Coordinated action was difficult, and initial responses varied. Some governments chose to guarantee bank deposits and provide emergency liquidity. Others nationalized troubled institutions. Investors watched for signs of weakness, and rumors spread quickly across continents. The use of U.S. dollars as a funding currency meant that stresses in American markets had immediate implications for institutions abroad, which suddenly found it expensive or impossible to access the dollars needed to fund their positions. The sense of security that had accompanied the housing boom, the belief that risk could be diversified away, gave way to a recognition that diversification also meant exposure to far-off events. In living rooms in London, Madrid, and Reykjavik, people followed news of American foreclosures and Wall Street rescues with a mix of curiosity and apprehension. Few would have imagined that those events would soon affect their own economies so profoundly. Yet, by late 2008, exports were slowing, construction projects were halted, and unemployment was rising in countries far from the origin of the crisis. The slowdown in credit and the loss of confidence had seeped into the real economy. A drop in orders for German machinery, a decline in demand for Japanese electronics, and a fall in shipping traffic through Dubai's ports were all part of the same story. The world had discovered, in a painful way, that finance knit together not only banks and investors, but also factories, shops, and households on every continent. As connections tightened over decades of globalization, they had brought growth and opportunity. Now they were transmitting distress. The summer of 2008 brought a series of dramatic turns. In July, U.S. regulators announced that two government-sponsored enterprises, Fannie Mae and Freddie Mac, which guaranteed or held trillions of dollars in mortgages, faced mounting losses. In early September, the government placed them into conservatorship, a move designed to ensure that mortgage markets would continue to function. The decision underscored how far the crisis had traveled into institutions once thought of as pillars. It also signaled to investors that the government would step in to support key parts of the financial system when necessary. A week later, however, the financial world was shaken by an event that had been deemed unimaginable: the failure of Lehman Brothers. After a frantic weekend of negotiations, no buyer could be found, and the firm filed for bankruptcy on September 15th. In the previous year, it had suffered heavy losses on mortgage-related investments and had struggled to raise new capital. When confidence evaporated, its funding sources disappeared. The collapse sent shock waves through financial markets. Unlike the Bear Stearns rescue, no backstop came. Suddenly, investors and counterparties everywhere asked who might be next. Money market funds saw redemptions. Banks became reluctant to lend to one another, unsure of what hidden exposures might lurk on balance sheets. Stock markets plunged and credit markets froze. The fall of a single investment bank exposed vulnerabilities that had accumulated across the entire system. Within days, another crisis emerged. American International Group, AIG, a global insurance company, had written large volumes of credit default swaps, contracts that insured mortgage-linked securities against default. As the underlying securities lost value, AIG was required to post more collateral. Without government assistance, it would not have been able to meet its obligations. On September 16th, the U.S. Federal Reserve stepped in with a rescue loan, effectively taking control of the company. The days that followed were a blur of emergency measures. Governments around the world guaranteed bank deposits and took stakes in major institutions. Central banks coordinated to provide liquidity in U.S. dollars to foreign banks. What had begun as a correction in one market had become a full-blown financial panic. In offices and homes around the world, people watched the news with disbelief, feeling the ground shift beneath them. The moment marked the transition from a period of instability to an event that would be recalled for decades. In those mid-September days, the crispness of autumn air contrasted with the fever in financial markets. Office workers commuted through swirling leaves while screens flashed red, bridging the mundane and the historic. It was not triumph or failure, but endurance, as societies braced themselves for the storm that had arrived. After the fall of Lehman Brothers and the rescue of AIG, the crisis moved from a series of isolated events to a broad freeze in the machinery of finance. Banks around the world were reluctant to lend, unsure which counterparties might be vulnerable. Companies, large and small, found credit lines curtailed. Consumers noticed that obtaining a loan for a car or a business expansion suddenly required hurdles that had not existed just months before. It was as if the bloodstream of the economy had slowed, leaving limbs cold and heavy. The slowdown crept like frost across a window pane. Governments responded with measures that would have been unthinkable in the placid years of the early 2000s. In the United States, lawmakers debated a plan to purchase troubled assets from banks in order to restore confidence. On an initial vote, the plan was rejected, sending markets into another tailspin. After days of intense public and political pressure, a revised package, the Troubled Asset Relief Program, TARP, passed, committing hundreds of billions of dollars to stabilize the banking system. Across Europe, governments nationalized or recapitalized banks, guaranteed deposits, and provided backstops for lending. Central banks slashed policy rates and opened new facilities to lend directly to institutions that could not obtain funds elsewhere. Together, these actions aimed to thaw the frozen credit markets, to reassure depositors and investors that their money was safe, and to prevent healthy firms from being pulled down by the undertow. The sense of crisis permeated daily life like a damp fog. Newspapers carried front-page stories about overnight meetings of finance ministers. Television news anchors, who once filled their broadcasts with lifestyle segments, spoke of credit default swaps and systemic risk. Ordinary people learned the meaning of acronyms like TARP and LIBOR. There was anger at banks and confusion about the future. Many wondered why public funds were being used to rescue private institutions. At the same time, a quieter anxiety about jobs and savings took root. Businesses delayed hiring and postponed investment. Families cut discretionary spending and postponed big purchases. The air of exuberance that had characterized the boom years was replaced by caution. Even as the extraordinary policy actions began to stabilize financial markets, the broader economy was slowing. The world was entering a recession, although the depth of the downturn was not yet clear. The period of frantic decision-making that followed Lehman's collapse would be studied and debated for years. But in the moment, it was defined by a single imperative: to keep the system from grinding to a halt. As the autumn months unfolded, meetings of central bankers became the new rituals. Phone lines buzzed across time zones, and the notion of coordination replaced the pride of independence. It was a time of whispered fears and quiet determination. By late 2008 and early 2009, the financial storm had spilled fully into the real economy, like a cold rain seeping through rooftops. Factories cut shifts or shut down altogether as orders dried up. Retailers closed stores. Offices thinned as layoff announcements became a routine part of the news cycle. In the United States alone, more than 8 million jobs would disappear over the course of the recession. In Europe, unemployment climbed sharply, particularly in countries that had experienced housing booms. In China, exports slowed, leading to factory closures and the return of migrant workers to rural villages. The crisis was no longer just about balance sheets. It was about families struggling to pay their bills and keep their homes, about graduates postponing plans because job prospects had vanished. The contraction was felt unevenly. Industries tied to construction and manufacturing were hit hard, while some sectors such as healthcare and education proved more resilient. Regions that had seen rapid house price growth experienced deeper downturns. Governments enacted fiscal stimulus packages in an effort to support demand, spending on infrastructure projects, and extending unemployment benefits. Central banks continued to lower interest rates. Even so, the pace of decline was startling. In some countries, output contracted at rates not seen since the 1930s. The term Great Recession entered the lexicon, capturing both the depth of the downturn and its historic nature. What distinguished this recession from many previous ones was not only its severity, but the way in which a financial crisis had transmitted through to the wider economy, amplifying a standard business cycle into a profound shock. Amid the statistics and headlines were countless individual stories. A small restaurant closed after its customers, worried about their own finances, stopped dining out. A young family moved in with grandparents after a layoff. They spent nights at the kitchen table, sorting through bills and letters from lenders. An auto worker took a job delivering packages. Communities rallied to support one another, organizing food drives and sharing resources. The financial world's language of liquidity and leverage gave way to discussions about resilience and adaptation. People learned to live with less and to find solace in simple routines. Even as conditions worsened, the human capacity to adjust emerged. The Great Recession tested society's social fabric, revealing vulnerabilities, but also solidarity. In the darkest months, when job losses were at their peak and headlines spoke of record declines, there were still moments of kindness and perseverance that would, in time, form part of the story of recovery. Winter holidays were muted, yet the hope that follows hardship flickered faintly. The slowdown in the advanced economies rippled into emerging markets in complex ways, like a pebble dropped into a still pond, sending waves in all directions. Countries that had fueled their growth through exports saw orders evaporate. Factories in Vietnam, Thailand, and Mexico, which had been humming to meet demand for electronics, clothing, and automobiles, shortened shifts or closed. Commodity exporters felt the shock as well. Demand for oil, metals, and agricultural products fell, driving down prices. Nations that had relied on foreign capital flows suddenly faced reversals as investors fled to perceived safe havens. Currencies depreciated and borrowing costs rose. In some cases, governments intervened to support their currencies, drawing down reserves accumulated during better years. The crisis revealed the vulnerability that comes with integration into global supply chains and financial markets. For decades, globalization had brought jobs and investment. Now, it transmitted uncertainty. Yet not all emerging economies suffered equally. Some had accumulated ample reserves and maintained stronger fiscal positions, allowing them to implement stimulus measures. Others benefited from continued demand in regions that were less affected. In China, for example, the government announced a massive fiscal stimulus that included infrastructure projects and incentives for consumer spending. The program helped soften the blow domestically and sustained demand for certain commodities, providing a lifeline for suppliers in Australia and Latin America. Elsewhere, remittances from citizens working abroad provided a cushion for families, even as job prospects dimmed in host countries. The crisis highlighted differences in resilience and policy flexibility, and it underscored the importance of buffers in a volatile world. For millions of individuals in emerging economies, the crisis was both distant and immediate. The images on television of collapsing banks and frantic traders seemed far removed from daily concerns, yet the effects were felt when a factory closed or a remittance arrived late. Rural communities that had recently seen young people depart for cities or overseas began to see them return. In urban areas, lines formed outside employment offices. The slowdown interrupted journeys out of poverty and reminded people of the fragility of progress. At the same time, it fostered new forms of ingenuity. Families started small enterprises, communities shared resources, and governments looked inward for sources of growth. The crisis, while a setback, also spurred conversations about diversification and self-reliance. The global financial shock had underscored how interconnected fortunes had become. The response in many places was to seek a balance between openness and resilience. In markets and meeting halls, talk shifted to regional trade and domestic demand, like farmers turning the soil for a new season. In the aftermath of the crisis's initial shock, governments and regulators embarked on the difficult task of rebuilding the scaffolding of finance, like carpenters strengthening beams after a storm. The experience had revealed weaknesses in oversight, incentives, and the buffers that shielded institutions from shocks. New regulations were drafted to address these gaps. In the United States, Congress passed legislation aimed at increasing transparency, limiting risky trading within banks, and creating mechanisms to wind down failing institutions without resorting to taxpayer bailouts. Elsewhere, regulators moved to tighten capital requirements, ensuring that banks would hold more of their own funds to absorb losses. International agreements, such as the Basel III framework, introduced higher capital and liquidity standards, curbing the excess leverage that had contributed to the crisis. Rating agencies faced new oversight, and derivatives markets were brought into clearinghouses to reduce counterparty risk. These reforms were not simply technical adjustments. They represented a shift in the balance between freedom and restraint in finance. During the boom, innovation had outpaced regulation, and the assumption that markets could self-police was widespread. After the bust, a new emphasis emerged on resilience, on ensuring that the failure of one institution would not imperil the entire system. Banks were required to produce living wills, detailing how they could be liquidated in a crisis. Compensation structures were scrutinized to align rewards with long-term performance rather than short-term gains. Stress tests, in which regulators assessed how banks would fare under adverse scenarios, became routine. The goal was not to prevent all failures, a near impossibility in a dynamic economy, but to limit their systemic impact. At the same time, policymakers wrestled with the question of how to support economic recovery without creating new imbalances. Interest rates remained near zero in many advanced economies for years, and central banks experimented with large-scale purchases of government and mortgage bonds, a policy known as quantitative easing. Some worried that these measures might sow the seeds of future bubbles. Others argued that they were necessary to avert deflation and stagnation. Debates about debt, austerity, and stimulus dominated political discourse. For citizens, the details of capital ratios and liquidity coverage meant little. What mattered was whether credit was available for their businesses and whether jobs were returning. The reforms, though often arcane, were part of a broader recalibration of the relationship between finance and society, like a gardener pruning a tree to encourage healthy growth. They reflected the hard-won lesson that complexity and innovation must be matched by oversight and prudence if stability is to endure. While the crisis inflicted pain across continents, its impact was not uniform. Like a storm that spares some valleys while flooding others, some countries weathered the storm better than others, reflecting differences in exposure, regulation, and economic structure. Its banks had limited exposure to U.S. housing markets and maintained relatively conservative lending standards. The prudential regulator had emphasized the importance of assessing borrowers' ability to repay, and subprime lending never reached the scale seen elsewhere. In addition, Australia's economy was buoyed by demand for its commodities from a rapidly growing China, which launched its own stimulus program. This combination of cautious banking and strong external demand cushioned the blow. Canada experienced a similar resilience, aided by stricter mortgage regulation and a financial system dominated by a handful of well-capitalized banks. In contrast, countries like Iceland, Ireland, and Spain suffered severe contractions. Their banking systems had expanded rapidly on the back of property booms, financed with foreign capital. When funding dried up and house prices fell, these economies faced deep recessions and, in some cases, banking crises that required international assistance. In Iceland, the banking sector was many times the size of the national economy. Its collapse led to a sharp currency depreciation and capital controls. Ireland nationalized failing banks and received a bailout from European institutions. Spain grappled with high unemployment as the construction sector, which had been a major source of jobs, contracted sharply. The contrast between these experiences illustrated how local choices and circumstances interacted with global forces. The crisis was global, but its effects were filtered through national policies, market structures, and the mix of industries. These differing outcomes also shaped the politics of reform and recovery. In places that avoided the worst, debates about regulation were tempered by concerns about stifling growth. In countries that experienced severe downturns, there was an appetite for change and, in some cases, anger at perceived excesses. Public trust in financial institutions varied, influencing how quickly credit flows resumed. Nevertheless, the shared experience of vulnerability fostered a broader understanding that no nation was fully insulated from global finance. Even those that fared better recognized that their fortunes were intertwined with decisions made elsewhere. The crisis encouraged discussions about regional cooperation and the need for stronger international financial architecture, like neighbors rebuilding together after a storm. For citizens, the differences were less about policy detail and more about lived experience. Whether jobs were available, whether homes retained value, and whether confidence could be restored. As the recession deepened and traditional policy tools reached their limits, central banks ventured into new territory, like explorers navigating uncharted seas. Interest rates, which had been lowered steadily throughout 2007 and 2008, approached zero in many advanced economies. Conventional monetary policy relies on reducing borrowing costs to encourage spending and investment. But when rates cannot go lower, other measures are needed. The U.S. Federal Reserve, the European Central Bank, and the Bank of England began large-scale purchases of government bonds and, in some cases, mortgage-backed securities. This quantitative easing aimed to lower long-term interest rates, support financial markets, and signal a commitment to combating deflation. It was a departure from past practice, an untested experiment undertaken in extraordinary times. For years after the crisis, these programs remained in place, and debates raged about their efficacy and risks. Proponents argued that without such support, the recession would have been deeper and the recovery slower. They pointed to the gradual improvement in employment and the stabilization of financial markets as evidence that the policies were working. Critics worried about potential side effects. The suppression of interest rates could encourage excessive risk-taking, distort asset prices, and make it difficult for savers to earn returns. Some feared that the expansion of central bank balance sheets would eventually lead to inflation, while others contended that the greater risk was prolonged stagnation. Economists and policymakers, once confident in well-established models, found themselves navigating uncharted waters, revisiting assumptions about how economies respond to shocks. The public, meanwhile, experienced quantitative easing in more tangible ways. Homeowners benefited from lower mortgage rates, making refinancing attractive and enabling some to keep their homes. Businesses found it easier to issue bonds to finance investment. On the other hand, retirees relying on interest income saw their returns diminish. Conversations about money took on new dimensions. Friends discussed not only job prospects, but also the role of central banks in daily life. In the years that followed, as economies slowly recovered, the unwinding of these unconventional policies became a delicate process. Policymakers sought to withdraw support without derailing progress. The experience left a lasting imprint on how society views the role of central banks, not merely as guardians of price stability, but as active participants in safeguarding employment and financial stability when crises strike. It also underscored the extent to which modern economies depend on trust. Trust that money will retain its value, that banks will honor deposits, and that institutions will act when the ordinary mechanisms falter. Trust is a fragile thread that holds the fabric of finance together. Recovery from a financial crisis is rarely swift, like a patient regaining strength after a long illness. In the years following the Great Recession, economies around the world began to heal at different speeds. In the United States, job growth resumed in 2010, but it would take until 2016 for unemployment to return to pre-crisis levels. Many who lost their jobs found new work only in different sectors or at lower wages. Household wealth, eroded by falling home values and stock market declines, recovered gradually. Consumers remained cautious, saving more and spending less. Businesses, scarred by the sudden withdrawal of credit, were slower to expand and hire. The sense of possibility that had characterized the early 2000s gave way to a more tentative optimism. In Europe, the path was complicated by the structure of the euro area. Countries that shared a currency but not a unified fiscal policy faced tensions between the need for stimulus and concerns about debt. Greece, Portugal, Ireland, and Spain experienced sovereign debt crises as investors questioned their ability to repay. Emergency loans from European institutions and the International Monetary Fund came with requirements for austerity and structural reforms. Debates over solidarity and responsibility exposed political fault lines. Northern European countries insisted on fiscal discipline. Southern economies pointed to the hardships imposed by cuts. The crisis within a crisis prolonged the recession in much of Europe and fueled political movements skeptical of integration. Even as the immediate panic subsided, high unemployment persisted, and growth remained sluggish across the region. Elsewhere, the pace of recovery depended on domestic conditions and the external environment. Emerging markets that had weathered the downturn resumed growth quickly, aided by domestic demand and, in some cases, continued demand from China's stimulus expansion. Commodity exporters benefited from a rebound in prices as industrial production picked up. But the memory of the crisis lingered. Companies built larger cash reserves. Regulators remained vigilant. Households hesitated before taking on new debt. Central banks kept interest rates low even as growth returned, wary of snuffing out fragile gains. The shadow of the Great Recession extended into policies and mindsets long after the technical recovery had begun. The world had learned that healing after a financial shock involves more than replacing lost output. It requires rebuilding confidence and reimagining the relationship between finance and the real economy. Movements calling for economic justice gained momentum. Public squares filled with debates on inequality and accountability. The crisis changed discourse and left lasting marks on how societies think about fairness, responsibility, and the distribution of opportunity. Voices in those squares were like a chorus, reminding leaders that recovery must be shared. With time, the crisis receded from the front pages like a tide drawing back from the shore, but its influence continued to shape decisions large and small. Households reevaluated their relationship with debt. Savings rates, which had been low during the boom years, ticked upward as people sought buffers against future shocks. The idea of using a home as an ATM lost its appeal. Conversations around dinner tables turned from how much equity had accrued to how best to diversify savings and reduce exposure. Younger generations, witnessing the volatility of stock markets and property values, developed a cautious approach to financial planning. The shared experience of instability fostered a collective memory that would inform choices for years. Businesses, too, adapted. Corporate treasurers held larger cash reserves, and supply chains were examined for vulnerabilities. Firms diversified funding sources and sought longer maturities to reduce reliance on fickle short-term markets. Risk management moved from the periphery to the core of corporate strategy. Even the language of corporate earnings calls shifted, with more emphasis on resilience and less on aggressive growth. Small enterprises embraced flexibility, adopting new technologies and business models that could weather fluctuations in demand. The crisis accelerated trends toward digitalization, remote work, and the gig economy. Some of these developments provided new opportunities. Others created insecurity. The relationship between employers and workers evolved as traditional employment gave way to more contingent arrangements. On a societal level, the crisis influenced public attitudes towards inequality and fairness. Discontent with perceived excesses and bailouts sparked social movements and debates about the distribution of wealth. The phrase, "too big to fail," became a rallying cry for reformers and critics alike. Occupy Wall Street and similar movements in Europe and elsewhere drew attention to the disconnect between financial prosperity and everyday experience. Policy discussions about minimum wages, health care, and social safety nets gained prominence. The crisis highlighted how deeply financial systems were intertwined with social outcomes. As people reflected on the factors that had led to such upheaval, many called for a more inclusive and stable form of growth. The years after the Great Recession were thus marked not just by economic recovery, but by a broader questioning of values and priorities, laying the groundwork for future debates about the kind of society people wish to build. In neighborhoods, community gardens bloomed and shared libraries appeared, modest reminders that resilience often begins close to home. Book clubs and volunteer groups grew, creating spaces where people could connect beyond headlines and numbers. These small acts were like threads weaving a fabric of care. One of the more unexpected outcomes of the crisis was a renewed emphasis on international cooperation, like neighbors building bridges after a storm. In the wake of the Lehman collapse, leaders from major economies convened emergency summits to coordinate responses. The Group of 20, which had previously played a modest role in global economic governance, emerged as a key forum. Finance ministers and central bank governors from industrialized and emerging economies gathered around the same table, recognizing that no single country could manage the fallout alone. Discussions ranged from immediate measures to stabilize markets to long-term reforms of financial regulation. Agreements were reached on principles to strengthen oversight, share information, and align standards. These conversations were not always smooth. National interests and political pressures loomed large, but the necessity of collective action tempered unilateral instincts. New institutions and mechanisms were also considered. The Financial Stability Board, an international body of regulators and policymakers, was tasked with monitoring risks and coordinating regulatory efforts. Central banks established swap lines, allowing them to provide each other with foreign currency liquidity. In Europe, the crisis set in motion deeper integration efforts, including the creation of banking unions and common supervisory frameworks. The experience underscored the need for early warning systems, cross-border resolution regimes, and clearer rules for handling failures. The recognition that financial markets had become global while regulation remained largely national spurred a conversation that continues to this day about the appropriate architecture for oversight. At a more personal level, the crisis fostered a sense of shared vulnerability among people in different countries. Stories of lost jobs, falling house prices, and anxious conversations about mortgages resonated across borders. In community gatherings and online forums, individuals shared experiences and sought advice. The universality of certain emotions, fear, hope, determination, bridged cultural and linguistic divides. While the mechanics of financial products might differ from one place to another, the human response to uncertainty was remarkably similar. This recognition did not erase differences, but it contributed to a modest sense of solidarity. When images of empty storefronts in Detroit, Madrid, or Dublin flashed on screens, they were viewed with empathy rather than distant curiosity. The crisis, in stripping away a sense of invulnerability, highlighted the interdependence of peoples and economies. It suggested that the challenges of a globalized world would require not only technical solutions, but also a willingness to see oneself in the fortunes of others. This sense of connectedness was a quiet lesson amid the noise. With the passing of years, the contours of the crisis faded, but its lessons remained etched into policies, memories, and institutions, like rings in the trunk of an old tree. The first and perhaps most enduring lesson was about the nature of risk. Diversification and innovation can be powerful tools, but they do not eliminate uncertainty. When many actors base their decisions on similar assumptions, the appearance of safety can mask shared vulnerabilities. The crisis revealed how models built on recent history may fail when history takes a different path. It underscored the importance of humility, of recognizing that markets can behave in ways that are not captured by past patterns. Regulators, investors, and households all became more aware that there is no substitute for understanding what lies beneath the surface of a security or a balance sheet. Complexity may distribute risk, but it can also obscure it. A second lesson concerned leverage and liquidity. Borrowing to invest can amplify returns, but it also magnifies losses. Funding long-term assets with short-term debt makes institutions vulnerable to sudden shifts in confidence. The crisis demonstrated that access to liquidity is not guaranteed, especially when many actors seek it at once. It reminded policymakers of the importance of capital buffers and of institutions having plans to survive periods of stress. It also highlighted the role of central banks as lenders of last resort and the need for clear frameworks to provide support without encouraging reckless behavior. For individuals, the experience reinforced the value of saving for emergencies and of maintaining flexibility in personal finances. Perhaps the deepest lesson was about trust. Financial systems are built on promises that debts will be repaid, that money will hold its value, that institutions will honor their obligations. When trust erodes, contracts become meaningless pieces of paper. The restoration of trust after the crisis required not only capital and liquidity, but also accountability. Investigations, reforms, and in some cases, prosecutions sought to address wrongdoing. Public debates about fairness and responsibility shaped the narrative of recovery. Over time, confidence returned, not through declarations of normalcy, but through consistent, transparent action and gradual improvement. The crisis also served as a reminder of interdependence. No one country, institution, or individual exists in isolation within a global economy. Decisions made in one corner can have far-reaching consequences. Awareness of that interconnectedness fosters a sense of collective responsibility. In reflecting on the crisis, many acknowledged that sustainable prosperity involves balancing ambition with prudence, innovation with oversight, and independence with solidarity. These lessons, learned at a high cost, became part of the fabric of economic thought, guiding decisions long after the panic subsided. And so, as years turned into decades, the crisis became part of history. Children who had been toddlers in 2008 grew into adults who knew the story not as a lived experience, but as something their parents spoke of when explaining frugality or caution. Homes that had stood empty were again filled with families. Banks that had been rescued returned to profitability under stricter rules. Regulators continued to meet, refining stress tests, monitoring capital ratios, and debating the merits of new financial technologies. Economies grew, faltered, and grew again, riding other cycles of expansion and contraction. The memory of the Great Recession lingered in policy debates and in the instincts of a generation, shaping choices in ways both explicit and subtle. It existed in the architecture of regulation, in the reserves held by banks, in the savings accounts opened by young workers, and in the wary optimism with which people regarded rising asset prices. In households, stories of lost jobs and regained footing served as parables of prudence and perseverance. The story of the global financial crisis was never solely about markets or institutions. It was about human beings navigating uncertainty. It illustrated how easily confidence can become complacency, and how quickly complacency can turn to fear. It showed that while prosperity can mask fragility, hardship can reveal resilience. People and societies adapted, learned, and in many cases emerged stronger. The crisis was not a single moment, but a long unfolding, a swell that rose, broke, and receded. Its legacy is not simply caution, but a deeper appreciation of the ties that bind individuals to one another through the instruments of finance. Whether lending a neighbor a hand, contributing to a pension fund, or paying taxes that support social services, we participate in systems of trust that carry us forward. Those systems are imperfect, but they also embody cooperation and collective action. The crisis taught that vigilance and empathy must accompany innovation, that growth should be grounded in real value, and that oversight is a form of care rather than constraint. Tonight, we drift away from that chapter of recent history with a sense of calm. The lights in trading floors have long since dimmed, and the headlines have moved on. Yet the lessons remain, whispered in classrooms, boardrooms, and family kitchens. Be mindful of risk, value transparency, nurture resilience, and remember that in an interconnected world, the choices we make ripple outward. Far beneath the surface, currents continue to shape our lives. But awareness can turn currents into guides rather than traps. Each generation will face its own challenges, its own booms and busts, and will carry forward the stories and wisdom passed down. As we settle into the quiet of the present, let us carry the wisdom of the past softly with us. The world slows, and so do we. Good night.